Hi, this is Ian Gendler, Director of Research at Valueline. We here at Valueline hope you and your family are staying safe and dealing with this difficult time as best as possible. Today, I'm going to provide an update on the coronavirus and its ongoing impact on the economy and stock market. I will also discuss the actions Valueline is taking to help our subscribers navigate this difficult time. I will then recommend one stock to buy right now, and finally, answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Valueline. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Valueline Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Valueline's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Valueline has no investment banking business with any company, including the 1,700 that are included in this service. Valueline does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. Now let's discuss the coronavirus, economy, and stock market. This content was prepared by Harvey Katz, Valueline's chief economist. The economic picture continues to deteriorate, with the focal point being the employment sector. Mounting layoffs have left 1 in 5 Americans now out of work. We say 1 in 5 because April's reported jobless rate of 14.7%, a level not seen since the Great Depression, was understated, as it excluded those not actively seeking employment due to stay-at-home directives. The May jobless rate, meantime, is almost certain to increase sharply, as will the overall number of unemployed persons. In fact, the Treasury Secretary, Fed Chairman, and some economists estimate that unemployment may reach 25%, which would be similar to levels only reached during the Depression. Indeed, more bad news is on the way as additional economic reports are issued. To date, we've suffered notable reversals in manufacturing and non-manufacturing activity, with the latter seeing particular weakness in production, new orders, and employment. Encouragingly, though, we may be nearing the low point of the cycle. True, the economic contraction may deepen for a time, but the pace of this descent should moderate as businesses reopen, even on a limited basis and with a smaller crew. If this progress carries forward, and it is likely dependent on the tapering off in COVID-19 infections, there may be some improvement in GDP by the third quarter. Still, the presumptive second-half business recovery will be limited, with high unemployment and low consumer and employee participation caused by social distancing at malls, restaurants, department stores, auto showrooms, theaters, and office buildings, probably meaning a V-shaped revival is not in the cards. At best, we may see a grudging increase in economic activity later this year. Yet, judging by Wall Street, even half a loaf is better than none, as the stock market continues to erase the losses suffered in late winter. Investors, it seems, are signaling that the limited reopening now underway will expand to incorporate many consumer and industrial sectors in the next few quarters. But even with a gradually better outcome on the COVID-19 front, it is unlikely that a return to business, as we know it, is around the corner. In conclusion, the stock market's April-May recovery has put equities back on reasonable levels, in our opinion. From here, further gains are possible, even likely. But we would focus on industries and stocks that are financially solid and will benefit from new technologies and evolving behavioral patterns. I want to touch on one sentence of Harvey's View, and I quote, "From here, further gains are possible, even likely." I truly hope this is the case, and maybe the odds are in favor of such an outcome, but I remain concerned. As stated earlier, the current economic situation is awful, and it's going to take a while to recover. Many in the medical community also assume that a second wave of COVID cases could hit this fall, which would of course significantly hamper a recovery, as well as introduce new problems. While I don't think that the stock market will retest the lows from February, I would not be surprised to see some backtracking, and even if the major indexes do advance from here, it probably won't be in a straight line. Thus, as I stated in my April 28th webinar, I again recommend that investors tread carefully and prepare for a bumpy ride. On that note, Valueland is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. However, Valueland provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of the Valueland Research Department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on Valueline.com. I will now show you how to access it. Once signed in, head to the dashboard where I'm already located. This is the main landing page for subscribers. Under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Today, we published updates on several stocks, including Home Depot, which was the one stock to buy right now in February. Since then, the equity has easily outperformed the S&P 500 index. We are also aggressively adjusting our financial strength grades. Individual companies are dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Consequently, corporations have been implementing cash-saving initiatives such as headcount cuts, the slashing of advertising budgets, and reducing or eliminating their dividends. Taking on additional debt has also been popular as a means to build cash in anticipation of difficult times ahead. Due to the rapidly deteriorating balance sheets, Valueland has been reviewing and altering our proprietary financial strength grades for the stocks in our universe. These changes are posted each week in our Selection and Opinion newsletter, and since there were so many changes recently, we have emailed out the list to our subscribers each Monday. For those of you that don't know, financial strength, along with price stability, another proprietary Valueland measure, are the two metrics that are used to calculate a stock's safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Valueland provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Certainly, particular industries and sectors will recover more quickly than others during this pandemic as well, of course. Now let's move on to the one stock to buy right now. For this, let's go to the screener. Valueline subscribers have access to 15 preset screens as well as 50 fields. I should also mention that another 100 or so fields are available, but that requires a higher level of subscription. If this interests you, please call 1-800-Valueline. Since I earlier preached caution, I am going to create a screen that only focuses on the most stable and successful issues. And I mentioned earlier the importance of our safety and financial strength grades. So we're going to start there. The safety rank measures the total risk of a stock and is arranged on an easy-to-understand 1 to 5 scale, with 1 being the most conservative issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. I'm only going to focus on those stocks ranked 1 highest for safety. These are the largest, most stable equities under our coverage universe. In fact, of the 5,700 or so stocks in our database, as you can see, only 123 garner this top rank. Now let's add an additional level of security. As mentioned earlier, loads of companies are reducing headcount, taking on more debt, and eliminating their dividends. Thus, balance sheets have greatly weakened. Although it's already a factor in the calculation for safety, I'm going to double down and include financial strength. These grades range from C to A++ in 9 increments. I'm only going with the A++ here. I want the strongest companies. Now down to 52. As most of you surely know, companies can massage their earnings per share figures via share buybacks, providing adjusted figures that remove costly items that management deems to be one-time in nature, and other methods. Sales and revenues, however, are more cut and dry. I want to include top-line growth since it will be a good indicator and display the companies that Valueland expects to thrive going forward, even if the economic situation remains depressed. So for my final field, I'm going to select the projected 3 to 5 year sales growth rate. This is a good time to mention that Valueland's analysts create projections out 3 to 5 years, and very few research houses provide that long-term view. I'm going to set the low bound to 10%, which is an annual expected growth. This will surely weed out most of the list. Sure enough, down to just 6 stocks. As you can see, these are all heavy hitters, with most in the technology space. This isn't all that surprising, since tech companies can, for the most part, more easily adapt to changing economic and social developments. For instance, their staffs can, relatively easily, shift to working remotely, and they aren't solely reliant on physical stores or locations. The one exception on the list is Starbucks. The coffee giant will almost certainly recover from this rough patch, but the possibility of a second wave of COVID has caused me to remove it from consideration. As for the other 5, there is certainly an argument to be made for all of them, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of my senior analysts, we prefer and recommend Google parent Alphabet, ticker GOOG. Before I go into specifics, please note that screens can be saved and reviewed later by utilizing the button at the top. Let's now click on Alphabet and get some information. As I'm sure all of you are aware, Alphabet is a tech behemoth. Its Google search engine holds a dominant position in its market, and the company also offers smartphones, data storage platforms, cloud services, and owns YouTube, among many other properties. In the banner section of reports, you will notice that the stock is now trading at around $13.89. Our 3 to 5 year target price range is $2,295 to $2,805. Clearly, we think that the stock has plenty of room to run. It is also ranked favorably for timeliness, Valueline's popular ranking system that predicts the stock's performance out 6 to 12 months. Simply, we think Alphabet may well outperform the broader market over the near and long terms. This is a good time to mention that Alphabet offers several share classes. We track GOOG, which trades at a slight discount to GOOGL. Shareholders of the latter have voting rights. Now let's take a look at our last full-page report, which was just published a couple of weeks ago. As you can see in the statistical array, or the center of the report that includes the financial data, Alphabet appears poised to achieve healthy annual increases in revenues, profits, and book value, among other measures. True, 2020 may be a bit of a struggle since the company does depend on advertising revenues, but the situation should greatly improve in 2021 and beyond. Please note that our estimates are in bold. Its balance sheet, which you can see information here in the capital structure and current position boxes, is best in class with more than $117 billion in cash and just $5 billion in debt. That cash hoard will certainly be put to work, and we would not be surprised to see a large acquisition within the next couple of years. Per Valueline convention, however, potential purchases are not included in our estimates. All told, we think that Alphabet's position is quite strong, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. I will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few questions that I'm going to tackle were submitted prior to this presentation. All right, first question. I just subscribed to Valueline last week, and I'm pretty new to the platform. If Valueline's analysis show timeliness ratings of 1 and technical rating of 1, but if the current price already reached the 18-month target price range and projections range, would this be a sign that in general it's already too late to purchase? Okay, so first off, Valueline obviously has several proprietary measures for the stock price and what we think is going to happen in the future. For instance, the technical rank is for the next 3 months or so. Timeliness is out 6 to 12 months. Our 18-month range is self-explanatory. And of course, we have 3 to 5 year projections. It's common for a stock to be positive in regard to one of those metrics, but lagging in another because of the different time frames. So stock may be timely. We think it's going to outperform in the next 6 to 12 months, but lag 3 to 5 years out. It's common. It doesn't mean you missed the boat. It may not be an interest to particular subscribers who have a different investment approach. If you're looking for relatively short-term profits, you're going to want to invest in technical and timeliness. If you're a more patient investor, you're going to want to use the 18-month or 3 to 5 year target price range. Next question. Are consumer staple stocks a good category to hold during a recession? Yes, that's typically to be true. You've noticed recently, for instance, Clorox has hit a 52-week high, or companies like Home Depot, which sell important household goods. If you are of the opinion that the economy is going to weaken further or remain weak for years to come, that would be a logical place to try to find some holdings. When do you estimate the recession to come to an end? Important thing to note, the official definition of a recession is 2 straight quarters of negative GDP growth. In the first calendar quarter this year, GDP contracted by 4.8%, I believe. In the current quarter, it's going to be far worse. There's some estimates 20, 30% contraction. So we're in a recession. How long is really going to depend on social distancing practices, testing ramping up. The U.S. is well behind in testing. If there's going to be a second wave in the fall, that's going to lengthen the recession, in my opinion. I think we'll be in a recession until 2021, in my opinion. How is the virus going to affect the national debt? Well, the debt has already increased in the past few months due to Congress passing several laws to stimulate the economy, to stimulate corporations, small businesses. Millions of Americans received $1,200 checks in the mail a few weeks ago, or that's ongoing. The House just passed another $3 trillion that is now going to the Senate. I don't know how confident it is that that bill is going to pass the Senate, and certainly President Trump's signature. But simply put, the national debt is increasing and will almost certainly increase further from here. Government officials, without getting too political here, currently are not concerned about spending, or at least not as concerned about limiting spending during this period. What is your outlook for crude? I'm going to pass on that question because right now we are preparing brand new reports on the major energy producers. On Monday, our website will have a new report on the petroleum integrated industry, which includes Exxon, Chevron, BP, etc. So I recommend coming back to our site on Monday. Are companies, even with mediocre balance sheets, worth buying when insiders are buying in large quantities? Yeah, I mean, there's no hard and fast rule. Obviously, today I preached strong balance sheets being important, but if people want to take a little bit more risk and they want to follow what insiders are doing, it's a reasonable approach. I just recommend proceeding with caution. What are the safest Canadian stocks that also offer a good dividend and growth potential? All right, so we currently track more than 80 stocks that are domiciled in Canada. Those are all included in the Valueland investment survey. Of that group, I suggest looking at the big banks, at least to start, including Royal Bank of Canada, Toronto Dominion, Bank of Montreal, and Bank of Nova Scotia. And that's just a few. All of them are under coverage. All right, now let me take a look at some more questions. Using the Valueland screener, what criteria is best to search for return over the next 6 to 12 months? All right, I mentioned the time in this rank being a measure of the next 6 to 12 months. So that would be a good place to start. I'm going to go to the screener and we'll take a look. So like safety, timeliness is on a 1 to 5 scale, 1 being best, 5 being worst. So I would recommend focusing on the 1s and the 2s. That should give you 400 stocks. And then, of course, you would whittle it down using other fields. For instance, since we talked about it today, maybe you want to weed out the particularly risky companies. So if we just did a quick screen of timeless 1 and 2 and safety 1 and 2, that would give you 145 stocks to play with. And then, of course, you can add in other information to reduce the number of candidates. All right, let me see what other questions we have. How does Valueland determine when to make a sell recommendation? So we provide quite a bit as far as when to sell. The timeliness ranks is a good example. If the stock is ranked 4 or 5, that suggests that by that metric, that stock is going to lag the broader market over the next 6 to 12 months. You can look at a stock's 3 to 5 year target price range. If the percentages out there are modest, it might show that the stock is overvalued. Another way is to use the graph. For instance, using this solid line, the cash flow line, that's a pretty good determination of what we think the value of the company is when looking at its cash flow. And the price dot was the price of the stock when we went out with this report. So as you can see, the price dot is below the line, suggesting that it's undervalued by this data point. If the price dot was materially above the line, that could suggest that it's overvalued and a time to sell. We also offer a number of products like Valueline Select, Valueline Dividend Income and Growth, in special situations, as well as model portfolios that are included in VLIS that give you direct sell recommendations. Each month or each week, they're actively managed portfolios. We tell you what stocks to buy and which ones to drop. Call 1-800-Valueline if you'd like to learn more. I sold GOOGL last week at a small loss. Would a purchase of GOOG be considered a wash sale? Or is this considered a separate company? No, they are both entry into owning Alphabet. They just have multiple share classes and voting rights is different. But like I said, GOOG trades at a discount and I believe a slightly higher daily volume. So that's why we cover it. But there's certainly nothing wrong with either share class. Buying one and holding it will lead to very similar, if not the same, gains. Recent lawsuits, any concern to long-term growth? Obviously, big companies are prone to restrictions or attempted restrictions by governments and other entities. I don't think it's going to materially impact Alphabet's prospects. It's kind of just part of business at this point. Does Valueland calculate return on capital? If so, where is it? It's in our reports. Return on total capital. For those of you who don't know, that is net profit plus 1/2 of long-term debt interest divided by the sum of shareholders' equity and total debt, and long-term debt, excuse me. It's a good indicator of how well the company is utilizing its capital. You want that percentage at healthy levels and, if at all possible, increasing. We take a look at Alphabet. You can see that it's significantly higher than it was a few years ago, but admittedly, we do expect it to plateau, albeit at a very healthy 16%. Advantages or disadvantages of owning GOOG versus GOOGL? I mean, the voting rights is important to some. For the average investor, we don't believe it matters. Any insight as to a buy entry point? Well, I am recommending it today, so I think it is priced at a reasonable level. I'm not saying it's undervalued. I mean, there's a reason why this stock has held up. I mean, it's still nicely below its 52-week high, which was well over 1,500. But I'd rather recommend in this market a stock that may not necessarily be a steal, but one that I think is going to perform well if there is rocky seas ahead of us, rather than one that is inexpensive for a reason. Can you comment how Valueland's projections did after 2008 in general? All right, well, one thing that comes to mind is the Valueline median appreciation potential, which we can see, which is published each week in the Summary Index on the front cover. I'm referring to this third box, 3 to 5 year median appreciation potential. That suggests that the median stock in our universe will increase in price by 80% in 3 to 5 years. Now, in March of 2009, when the market hit its low, that percentage was something like 180%. And 3 to 5 years afterwards, the market had increased over 200%. It has been a pretty fair indicator of the market's long-term potential. And I recommend you do a Google search on it. You can type in VL map, Valueline median appreciation potential. Several writers have written articles about it that are not affiliated with Valueline. They were independent studies. And the track record's impressive. It's an important stat to look at. Actually, all 4 of these are important stats to look at on a regular basis. Gives a really good approximation of how the universe is being valued at the time. How safe is it to buy real estate stocks? In my opinion, not very safe at the moment. Some of them are very depressed. If you look at REITs, for instance, but a lot of those companies have reduced their dividends or eliminated their payouts. If you have a long-term view and you're risk tolerant, there may certainly be some deals there, but not really my cup of tea at the moment. Can search data be downloaded to Excel? Yes. Our screener and other data does have export capabilities, but it comes with high-level subscriptions only. For your stock to buy right now, where is the evaluation of the chart? I looked at the chart here, but it's also available on the digital report in the valuation module, which I'll show you. Show chart. There's the chart. All right, let me see if there's more questions. Does Valueland cover REITs? Yes. The Valueland Investment Survey covers, I believe it's 50 REITs or almost 50 REITs. They're a big part of our universe. Do you have a report on or expectations for commodities like gold? Yeah, we have a precious metals industry. So we talk all about gold prices and our thoughts. All right, I'm going to take one or two more questions. How often does Valueland add new companies to the database? Every week. Whenever companies IPO or gain listing, we try to add them as soon as possible. For the Valueland Investment Survey, for instance, we try to always cover more than 1,700 stocks. And of course, stocks go out due to acquisition, delistment, bankruptcy. Bankruptcies are unfortunately fairly popular right now. So we're always adding stocks to replace those that we've lost. For instance, this past week we added Ryanair, which is a airline based in Ireland. All right, I'm going to take one more question. There's a couple questions about Berkshire Hathaway. We're going to have a new report on Berkshire hit our site not this coming Monday, but the following Monday. All right, one more question. Here's a subscriber to the Valueline 600 print. If you would like, you can get, in addition, digital access added to your account. Just call 1-800-VALUELINE and speak to an account representative, and that can be done very easily. All right, I'm going to stop there. Thank you so much for your participation and questions. Please stay safe and take care.